And I don't know why anybody isn't talking about this, because they should. You can still make money on the side if you're under that total taxable income and be able to leverage your retirement and create more wealth and not have to pay any tax on it. Hi, I'm Candy Valentino, and for the last 25 years, I've been building businesses and generating wealth, starting my first business when I was just 19. Since then, I've gone on to build, scale, acquire, and exit businesses, all while investing in real estate and building financial freedom. Now it's all about you and why we're bringing you the real story behind building businesses and generating wealth here at the Candy Valentino Show. Hey guys, welcome back to another episode of the Candy Valentino Show. I am so glad that you are tuning in with me today. You are the first to join me on my brand new set. This is our first spin in the solo set. Let me know what you think below. Shoot me an email, a DM. I'd love to hear from you. Drop it in the comments if you're watching this on YouTube or Rumble. But when I first got here today, it was so interesting because I was thinking back on not just the last 18 months since I've been doing this front camera, if you will, but really the last 25 years. And it has been such a ride. I am so immensely grateful for you, every one of you, the listener, the watcher, the book buyer, the event attendee, and all of you that were from my prior life with building businesses and investing. But however you came into my world, thank you for being here. I'm so grateful to be doing this with you. And I also just have to shout out a huge thank you to Bob Sullivan, to Kathy, to Cynthia, to Delaney, to Jen, the entire production team here, Tyler, everyone that is working to make this so beautiful. None of this would have happened without all of you. So thank you. Thank you for your belief in me. Thank you for making us so fancy. So now, although the set is new, the information that we prepare for you is not. Our commitment is and always will be to bring you the real story behind what it takes to build a business and create more wealth. So this is your destination for no BS, unfiltered, unapologetic information that you need to make more, keep more, and ultimately create the rich life of your dreams. Now, today is the first episode on this new set and the first episode of our real estate investing series, and we're going to start it off with what started this whole platform of mine, which was posting tax tips on TikTok during COVID. So we're going to dive into the world of real estate investing. We're going to explore some of the top and some of the often missed tax deductions that can help you maximize your returns, which will then help you build more wealth. So if you're ready, I'm ready. Let's get started. All right, short-term versus long-term capital gains. Now, first, we got to get into deductions, but let's talk about the cornerstone of real estate tax rates. This is understanding and identifying the difference between short-term and long-term capital gains rates. Now, by definition, short-term gains occur when you sell a property that you've owned for 1 year or less. These gains are important to remember that they are taxed at your ordinary income tax rate, which can be substantial. I learned this the hard way as I was investing in real estate. And although the U.S. income tax rates are staying the same for this current tax season and the next, here's what they did. The tax brackets, which are the buckets of income that are charged at higher rates, they went under some major shifts with the biggest increases in decades. And I don't know why anybody isn't talking about this, because they should. There was roughly a 7% change in the federal tax brackets from 2022 to 2023, which is far more significant than typical. Now, why do these rates or brackets matter? And why did they change? Well, they're going to tell you that they changed to adjust for inflation, but it's far more dependent on the political cycle and who's in all of the offices, the branches of our government. In 2023, there are 7 federal income tax rates: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Your taxable income and your filing status, which is single, married, will determine which tax bracket applies to you. So that's all short-term gains. That's under the short-term gain bucket. Remember, short-term gains under 1 year is the very same as your earned or active income. Now, on the other hand, we've got long-term gains. This comes from selling a property that you've held more than 1 year. And although tax rates and rules change over time due to legislation changes, long-term gains are often taxed at a lower rate than short-term gains, thanks to the tax laws designed to incentivize investors in real estate. Now, as always, it is essential to check the most up-to-date information on capital gains rates on the IRS website. You can go to irs.gov and always consult with a tax pro who can help you understand and apply the 6,000 plus pages of the IRS code. So long-term capital gains, they were subjected in the United States to some pretty preferential tax rates. The specific tax rates for long-term also depends on your income level. So here's how this stacks. You have a job where you make so much money. Now you're actually selling a long-term. You have a long-term capital gain. It can take you into potentially other tax brackets. For the 2023 tax year, individual filers won't pay any capital gains tax if their total taxable income is less than $44,625, which means you could still have a job that you make $35,000 or $40,000 and you decide to buy a property that's an investment property and fix it up, or you start to do wholesaling. You can still make money on the side if you're under that total taxable income and be able to leverage your retirement and create more wealth and not have to pay any tax on it. Think of that, tax-free money. That's really hard to get nowadays. The tax rate jumps to 15% on capital gains if your income is $44,626, the whole way up to $492,300. So again, let's break this down. You have a job that you make $100,000 in, and you want to start investing money in real estate. Instead of you paying your earned income tax rate on all of that money plus your earned income, the government's going to allow you to pay 15% on the gains of that property while you pay earned income on your money. Now, when you go above $492,000 in income, of course, the rate is going to jump a little bit, but still lower than tax rates at only 20%. Now, the rules vary for specific types of assets or situations, so always consult the IRS guidelines, a tax pro, for your precise information that's tailored to your circumstances. Now, that brings us to one of the best rules when it comes to real estate investing. That is the 1031 exchange. Now that we covered the first cornerstone of real estate taxes, we got to talk about the second one, the benefits of a 1031 exchange. This is a powerful tax strategy that allows investors to defer capital gains taxes when selling one property and purchasing another like property. There are some very important critical steps that you have to take. The government doesn't make it easy. You have to make sure to do a few things on this one. Here's how it works in 6 steps. I'm going to try to break it all down as easily as possible. Number 1, like property. It must be a like property, meaning a commercial property to a commercial property, an investment property to an investment property. You can't sell your house and then buy some other thing. It has to be like property. Number 2 is identify the replacement property. The 1031 exchange gives you 45 days from selling that property to identify a potential replacement property. And then number 3 is the most important. You only have 180 days to close that deal on the identified replacement property. Number 4, a qualified intermediary. The IRS mandates that you use a QI to prepare all the legal side and the documents for this exchange. Number 5, proper title. I have seen people try to use this and mess this step up, so make sure you get this right. Make sure that you purchase the title of the new property as the exact way that you held the title for your old property. So let's use this in real terms. Let's say I go out and I buy a property that's an investment property that I hold for longer than a year, so I get long-term gains rates. But then I want to use the 1031 exchange to defer that tax. If I had that property in Candy Holdings, I can't go buy the next property in Valentino Holdings. I have to make sure that it is the same title, the same way. So make sure you don't mess that up. Number 6 is deferring taxes. By adhering to these rules, you can defer those capital gains, which allows you to reinvest your tax-free money and potentially grow your wealth even more over time. All right, that brings us to another tax strategy that a lot of people aren't leveraging or even know about, and that's cost segregation. This is another valuable tax deduction strategy for real estate investors, particularly in commercial real estate. This allows you to accelerate depreciation on certain components in your property. Here's how it works. Stay with me. This is important. Number one, hire a professional. Engaging with a qualified cost segregation specialist, they will conduct a study for your property is number one first step, and it's key. It's so important. Number two, they do the work to identify the proper components. So they will go through this property and identify what parts can be depreciated over a shorter period of time. As an example, the HVAC system or the lightings in your home. Those are all things that you would be able to have a shorter depreciation schedule, which gives you more benefits. Number three, you take the tax benefits. By accelerating depreciation on these very specific components inside the investment property, you can reduce your taxable income and ultimately the total money that you hand over to the IRS. That brings us to the third. This is the short-term rental loophole. For those of you that might be doing some short-term rentals, whether that's a short 30, 60, 90-day lease or Airbnb and VRBO, there is a pretty exciting loophole in the tax code that I see so many multi-million-dollar investors miss. If you rent your property for 14 days or less, this sounds very much like the Augusta loophole if you follow me on social. You may be exempt from reporting that rental income on your tax return. So let's break this down. The Augusta loophole is for your primary residence, and the short-term loophole is for your investment property. This can be particularly beneficial for those who rent out their places during special events or tourist seasons, you name it. So here is an STR tax tip. Placing a property into service is different for short-term and long-term rentals. Now, I don't want to bury you in the weeds, but these are just a few highlights. And it's always good to expand your knowledge because like I always say, I'd love to elevate the conversation of business and investing because you don't need to keep and retain all of this information. In fact, we only retain 7% of the information we hear. But sometimes what this will help you do is have better conversations so that you're not leaving your money in somebody else's hands. If you're not working with a strategist or you're not working with a CFO firm and they haven't brought these things to you as an investor, these are conversations that you are going to want to start so that you're not sending more money to the IRS than you have to. The long-term rental for this is a rent-ready property. This means that someone could safely rent the property and the property is advertised for rent. The short-term rental description is the property has been rented for at least 2 to 3 times during the current year. The more the better. When you utilize a cost segregation study and the bonus depreciation, you maximize the benefits of the STR loophole. Now note, a short-term rental is considered a non-residential property and should be depreciated for 39 years, not 25 and a half. Now, there are a few misconceptions on this topic, and although one tenant cannot sign multiple short-term leases to get around this, there is a 7-day average requirement. Another is that personal use of the property matters. Be sure that you have 14 days or less of personal use. And if using the 100 hours or more than anyone else material participation test, you must track others' time on the property. So there's a bunch of these and we don't want to get buried into all of the details. I just want you to know enough so that you can start to have these conversations so you're not leaving money on the table. Now, here's the thing, why this is so important and why a lot of these tax deductions we talk about are key. We worked with a client, I think I talked about this on a prior episode, where he was selling his business. He was rolling up a few different entities that he had into one exit and was exiting for around $12 million. He was not working with us at the time. He had got his tax bill from his accountant and his CPA, and he was going to owe more than $3.8 million. Ouch. You're finally excited to sell your business for all of this money, and then all of a sudden, over a quarter of it, a third of it is going to go out to the IRS. So thank goodness he reached out. By us taking a look at some of these things I just talked about, which included him owning a commercial building, which included a short-term rental loophole, there were a lot of ways that we were able to reduce the amount of tax that he paid, and not just by a little, not just by 100,000, not just by $1 million, but by more than $1.8 million. That is why these are so important to understand and leverage should you have the situation that allows you to. So a few other things that you need to do to really leverage this loophole. Don't hire a property manager in the first year that the STR is placed into service. Make sure that you track your time and the time of anyone else who works on the property in that first year, whether it's cleaners or contractors or whatever it may be that's doing work on the house, landscapers. Perform that cost segregation study in year one to really capture the majority of the tax benefits from this loophole. Hire a property manager and no longer materially participate in year two, or convert it to a long-term rental. There are so many ways that you can use and leverage this, but it's really important once you get it, once you understand it, and once you use it, that you can rinse and repeat next year. My point in all of this today, guys, is that real estate tax deductions can significantly impact your investment returns by understanding the differences between short-term and long-term, how to leverage a 1031 exchange, how to explore the cost segregation studies, how to consider using the short-term rental loophole. You can make more informed decisions that will enhance your financial position, not just now, but really in the future. And as always, this is the little legal part I got to throw in here. Tax laws will change, and they can change at any time. So it is always essential to consult with a qualified tax pro to ensure that you are taking advantage of these deductions and doing it in the right way. If you need a great tax strategy firm, I happen to have one. You can work with us. Go to vallardadvisors.com to apply and connect with one of my business partners. All right, guys, that is all for today's episode. Thank you so much for tuning in and spending this time with me on our very first day in the solo set. We'll see you next time.